I see a lot of individuals, they blame the Federal Reserve for propping up an overinflated stock market. While I agree with part of the reason, I think there are more factors to that beside that. Some people may say, hey, it's earnings that are driving the stock market, not necessarily the QE, but a certain part of it's QE. Well, both I would agree with to a certain degree. It's QE, it is earnings, and what people are failing to acknowledge is the yen carry trade, right? No one blames the Bank of Japan, and I want to, first of all, before I get into this graph, explain what the carry trade is for some new people who are listening. So what is a currency carry trade for those that are new? A strategy in which an investor sells a certain currency with a relatively low interest rate and uses the funds to purchase a different currency yielding a higher interest rate. A trader uses the strategy attempts to capture the difference between the rates, which can often be substantial depending on the amount of leverage used. And let's look at an example. Here's an example of a yen carry trade. A trader borrows 1,000 Japanese yen from a Japanese bank, converts the funds into US dollar, and buys a bond for the equivalent amount. Let's assume that the bond pays 4.5% and the Japanese interest rate is set at 0%. The trader stands to make a profit of 4.5% as long as the exchange rate between the countries does not change. So basically, they take the yen, convert it into a higher interest rate currency, such as the dollar, and invest in maybe the US stock market, equity market. That's what's probably happening. And that graph will illustrate that. So if you look at this carry trade, which is perpetuated by the Japanese central bank, it is, number one, profitable for many traders, but when the trade unwinds, many people lose their shirts. Okay, now let's look at this. The blue represents the S&P up until 2014, March 2014, started in 2011, the first day of the year. And if you look at this, this is next to the Japanese dollar yen, or the dollar yen chart. So if you look at this chart, it's not going in the same exact manner, but you could see that more times than not, the S&P has been following the dollar yen. And once again, this goes back to what I was saying about a carry trade, where you take cheap interest rate currency like the yen, invest it in higher interest rate currency, such as the dollar. And when you invest in the dollar, you're maybe investing in the S&P, like this graph. See? See where that liquidity is going? So no one is blaming the Japanese central bank about the overinflated stock market. They always say the Fed this, Fed that, and blame Bernanke, blame whoever, but they're not blaming the Japanese, right? And they are also to blame for this. I mean, this reminds me of the Chicago Bulls, right, in the 90s. Everyone said, hey, the Bulls were great because of Michael Jordan, Michael Jordan, Michael Jordan. Well, he had another guy there to help him out, Scottie Pippen, right? And now if you want to look at the equity market, everyone says the Fed this, Fed that. And who else is there, though? The Japanese central bank, okay? I mean, not to say that Jordan and Pippen are like the central banks. The central banks are evil, right? They're the bad guys, as Big Swear would say. And the good guys would be Michael Jordan and Scottie Pippen, right? From Chicago, especially. But put that sports analogy aside. Okay, if you see the Japanese yen, right? This carry trade is, I think, one of the important reasons why we see the stock market go up. Yes, QE is correlated with the higher stock market, and 3, earnings, right? So if you look at all that, and also you see the EPS, earnings per share, manipulated by stock buybacks, which is perpetuated by easy money by central banks as well. So you have all of this nonsense going on, and that's why you see stocks like LinkedIn with a PE ratio of over 850. And as a disclosure, I'm short LinkedIn. So you see ridiculous valuations in parts of the economy, in parts of the stock market, and that's one of my concerns about what's going on right now. But I wanted to go to one more part before I end this video. So if you see the dollar yen is like 76-ish right after Fukushima, like a few years back, right? And what does that mean? It means that the Japanese yen was appreciating when it got to 76. So the lower the dollar yen goes, that means that the carry trade's unwinding. And what happens is when you have wild fluctuations in the currency markets, you have manufacturers complain that the country's currency is getting too strong, like in Japan in 2011. They threw a fit. So the Japanese and the United States, in my opinion, they had some sort of quid pro quo agreement where the Japanese would, number one, let their currency depreciate, meaning that the dollar yen would go higher. Right now it's 103. And at the same time, the United States is saying, okay, the Japanese, you have to help us out in some way, shape, or form. In my opinion, what was done is the Japanese bought more treasuries. That was the quid pro quo agreement. While the Chinese may have said, you know what, we don't want to buy treasuries. And I'll show you this one chart. So now look at the Chinese holdings. This is of 2011, June 2011 to June 2012. As you can see, the Japanese held around $900 million worth of treasuries, and that increased a year later to June 2012 to close to $1.1 trillion. And if you look at June 2011, Chinese held $1.3 trillion of treasuries, and that decreased to a little, I think, $1.15 trillion, something like that. So as you can see, Chinese treasury holdings fell, Japanese treasuries went up. And that was the quid pro quo agreement. Because remember, when the Japanese are depreciating their currency against the dollar is getting stronger against the Japanese currency, so it hurts U.S. companies that are exporting to Japan. So that was the agreement, in my opinion, of why or how the Japanese were able to pull that off. And in addition to that, you did see lower gold prices as the Japanese yen started to appreciate. It started to depreciate, meaning that the dollar yen went up to 100. So a lot of people saying, hey, market manipulation, this and that. And yeah, I think that all markets are rigged. But I think one of the reasons how they got the gold price to go down, to be honest with you, my own thoughts, is that all they did is they just reversed the yen carry trade to go in the opposite direction. And because of that, they managed to make the gold price go down. I mean, there were other factors as well, but I think that was one of the ways that they did that, through the currency markets, which a lot of people in the gold manipulation camp, they don't talk about that. I mean, I'm the only one that talks about that. And all I can say is that to get the whole message out of this video, don't simply blame the Fed, blame the Japanese central bank as well. Thanks for listening, guys. Talk to you later. Bye.